Hi everyone, we're here today with Dave Bassanese, Chief Economist and Chair of the Investment Committee at Betashares Investments, to talk through the current state of the local and global economies and outlook on markets going forward. Good afternoon, Dave. What a couple of days of markets it's been.
Yeah, look, we're certainly going through some volatile times at the moment. Yeah, great to be with you.
Yes, certainly. And even today, markets are taking that bit of a dip and then, starting to come back, but certainly still in the red. Yeah. Okay, I'll hand it over to you, Dave, to give us a walk through the economic update, and then we'll have a couple of questions from there.
No worries. Yeah, great to be with you also. Look, I'll just run through some of the, the developments in markets at the moment, what's going on in the economy. And yeah, as you know, as we've just mentioned, there's certainly been some volatility of late. As the title here highlights, really the key driver of markets at the moment is the plans by the US President Donald Trump to significantly increase tariffs, which are a tax on US imports into the US. And we're having some countries retaliating by increasing their tariffs against the US. And the big risk is, what that may do to the US economy and in turn financial markets. So let me just get into that. Obviously, this is just general economic information. In no way regard anything I say today as personal advice. You've got a very good advisor, in your corner, and nothing I'm doing here is familiar with your, personal situation and needs. So with that proviso in place, let's just, get to the key issue at the moment. So what I've got here is a chart of US tariff revenue as a share of imports, and you can see that there's been periods in the past, as has been the case in many countries. The US used to rely on tariffs, taxes on imports as a way to raise revenue back in the old days, going back to the 18th century, even the early 19th century. An easy way to raise taxes when you didn't have a modern system where you could tax corporate profits and incomes fairly easily. But then, through globalization and free trade movement, it really reached rock bottom levels. The average collection was about 1% to 2% prior to Donald Trump coming to power back in 2016. He did marginally raise tariffs in 2017-18. He raised them from about 1.5% to 3%. Still very small. But as you can see, the proposed tariffs that he announced last week effectively raised the average tariff rate to just over 20% of imports. So an average effective tariff rate of more than 20%, the highest level in 100 years, if that were to get through. Now, the problem with tariffs, look, the argument for this, why would Donald Trump do something like this? If you increase the tax on imports, you raise their price in theory, you'd be raising the price of imports into the US. It makes them less competitive against local production, and it's supposed to help then boost US manufacturing activity and help, get a few more blue collar workers having jobs in factories and stuff. That's the whole rationale for these tariff increases. The problem is that that's nice in theory, but there's a lot of difficulties around it. Firstly, a lot of companies do use imports into their own production, so they might produce US goods and services, but as part of that producing of those goods and services, need to import parts to go into that process, and those costs are going to get raised. The US exporters also face retaliation in other markets. We've seen China retaliate to the tariffs proposed on it by raising tariffs 34%. So that's going to make exports of the US into other countries more difficult. It also raises inflation. Imports are about 10% of US consumption. So if you raise tariffs by about 20%, it's up to about a 2% hit to inflation potentially in the US. And that tax revenue has to be paid by someone, and usually it's paid by either the US importer or the US consumer if the tariff increases are passed through to final prices. And so that is a hit to real after-tax income. So that's all the negatives with tariffs. There is a potential long-run positive, but the problem is up front that it's mainly negatives for the US economy. And people are dubious about the benefits down the track because, in the case of low labour-intensive manufacturing like footwear, for example, even with tariffs, it's still very much more expensive to produce sneakers or clothing, for example, in the US. So you're not going to get a lot of substitution even with these tariffs to local production. So here are the arguments. The question now is whether these tariff increases will cause a recession. And recession is really critical for the US because that's when you get the worst of the equity market declines. At the moment, the US market is down around about 17% from its high. If you did get a recession, there might be another 10, possibly 20% downside, in the worst case scenario of recession. So I've just got there some of the arguments for and against our recession. And again, one of the biggest the arguments of why a recession could be avoided is at least the uncertainty of those tariff increases are behind us. At least business potentially know what they face, and they can at least start to make plans along those lines. The other argument against is that Trump could relent. He could start to negotiate. He could lower those tariffs if other countries reduce their trade barriers. Other countries could do offsetting stimulus. And importantly for Australia, it should be a minimal impact because the exports we sell to the US are, as a share of our own economy, are pretty small. And we're not raising our own tariffs, so we won't get any increase in import prices as a result of any retaliation we might have put on the US. We're not doing that. So at least it gives the RBA, there's no ambiguity in terms of what the RBA needs to do if this does hurt the economy, because it'll really be mainly depressing growth, not putting upward pressure on inflation. So the RBA can respond if need be by cutting interest rates. The arguments that suggest things could get worse is we could get a tit-for-tat escalation in the trade wars. Yes, the uncertainty of the first round of announcements are behind us, but he could still, even if Trump wants to negotiate and reduce those tariffs down the track, that just leads to further uncertainty. Businesses are going to, want to hold back on investing because they're just not sure whether these tariffs are going to remain in place or not. So just the uncertainty could hurt matters. There's a few other arguments there as well. But at the bottom line for me is I think recession risks in the US have certainly increased. But it's not yet base case. And I'm still counting on Donald Trump or the US Federal Reserve intervening before things get too bad. So I think, if push comes to shove, Donald Trump, I think, may well open the door for negotiation to say, let's talk. And, if you cut your tariffs, I can cut mine. Because I don't think at the end of the day, Donald Trump wants to cause a recession. And if it does happen, he'll be squarely to blame because it's been his policies that have put us into this situation. Just in terms of Australia, look, the news here so far, post the tariff issues have been pretty good. Unemployment's remained fairly low at just over 4%. Employment growth's been quite strong. But the strength of the labour market has not come in the way of inflation continuing to fall. You can see I've got there the underlying measure of inflation in Australia. It's called the trim mean. I won't get into the details of it, but just suffice to say it's a measure of, it strips out the more volatile price components either on the upside or the downside on each quarter, and we get a more of a representative sample of what's going on across the economy in terms of inflation. You can see that the quarterly numbers come down to 3.2% for the December quarter, and the monthly numbers as of February is down to 2.7%. So it bodes well for further declines in inflation in Australia, and bodes well for the RBA continuing to cut rates after it cut rates in February. And again, the RBA's target band is for inflation to be back into the 2 to 3% band. And as you can see on the monthly trim mean, we're already there. And I think we'll see the next quarter CPI that comes out late April will show that orange line ticking under 3%, possibly to around 2.8%, be my forecast. And I think that will open the door for the RBA to cut rates again in May, and then again at least once, if not twice more this year, depending on what happens in the United States with regard to recession. Excuse me. A couple of reasons to be hopeful on the inflation front. This is a a chart that looks at the relationship between unemployment and wages growth. Unemployment is on the bottom axis there, wages growth on the y-axis. And you can see that usually when unemployment, to get a decent decline in wages growth, you need unemployment to increase. But what we've seen over the past year or so, we've had a nice decline in wages growth from over 4% to just over 3%, without any a material increase in the unemployment rate. So we've managed to achieve a soft landing, without any deterioration in the labour market, which is, pretty good news if you are counting on lower interest rates ahead. We haven't needed to push the economy into recession to get wages growth down, to get price inflation down from those highs that we saw during COVID. And the other factor supporting lower inflation in Australia is an easing of housing costs. You can see house prices in Australia have come off a little bit in recent months, and really just the affordability of homes, the affordability of rents have reached a level that it's very hard for people to bid a lot more for property and rental properties. And so we're seeing a levelling off in those prices, and that feeds through into inflation as well. So easing of wages growth and easing of rental and housing cost pressures are the primary drivers of that easing in inflation that we've been seeing. So again, I think more rate cuts are likely in Australia and in the US, as growth in the US will slow to a degree. The Fed are going to, the US Federal Reserve, their central bank is going to be a little bit more cautious in cutting rates, again, depending on what happens on the tariff front, because those tariffs are going to be raising prices in the short run, and the Fed will be concerned that it doesn't want to embed higher prices into inflation. So I think it's going to cut rates, but probably cut rates more toward the latter end of this year. That bodes well for, as interest rates do come down, and particularly if growth does slow in the US, bond yields should go lower. You can see there, it's a chart of US 10-year bond yields and the Fed funds rate in the US. And generally, if the Fed is cutting rates, bond yields are falling. If bond yields are falling, the return on fixed rate bonds goes up, so you get a nice capital gain, which is a reverse of what we've seen since 22, for example, when the Fed was raising rates. So we're unwinding some of the losses that we saw in the fixed rate bond area through 22, 23, and part of 24. Equity markets, look, again, everything is subject to the tariffs at the moment. My base case is Donald Trump won't let the economy tip into recession. He'll pull back if need be. And that should continue to support good growth in corporate earnings, particularly in global markets. You can see their markets were rallying nicely up until the recent pullback. The pullback has at least restored valuations in some markets. So the US market was one of the challenges was trading at a pretty high valuation of prices relative to earnings. But as prices have come back, that valuation is not as bad as it would be. And at the moment, at least, the earnings expectations are still quite positive. So I'm hopeful that, we won't see a lot more downside in the equity markets, but certainly in the short run, I think there's more volatility ahead. But hopefully if cooler heads prevail, markets can bottom out fairly soon and start to mount a recovery. That's the state of play in markets at the moment. Just some risk factors to consider there. But with all of that, I'll leave it there and open it up for any questions you may have.
Thank you for that, Dave. Quite comprehensive, and things are certainly very short term, a little bit volatile, but longer term, hopeful for a cooler heads to prevail. But we'll see how things go in the US Capitol. I'm not sure there's that many cooler heads there sometimes, but we'll see how that goes. I think you pretty much covered off most of those things that we talked through, looking at that fixed interest outlook, which bodes well for our current holdings, which we have quite a bit of that fixed interest for our retiree markets, our retiree clients, sorry. And I think, my big probably point then to check on is how did the portfolios go through that March month, and how are we sitting at the moment?
Well, in terms of fixed rate bonds, I mean, in this sort of risk off environment at the moment with the concerns around the US tariffs, you've certainly seen good gains in fixed rate bonds. So if bond yields come down, markets start to price in central bank interest rate cuts. It means obviously the interest rate you get on, short term cash and passbooks and whatnot goes down. But the capital gain on the holdings of fixed rate bonds goes up because you're holding bonds that are have a higher interest rate sort of priced into them, so the value of those goes up. The equity market decline, we have had equity market declines in recent weeks, so that's been a bit of a drag on portfolios. But certainly in the more defensive portfolios where there's a lot of fixed rate bonds, a lot of cash, not so many equities, the returns have been quite good.
That's good to hear. That's really good to hear. Obviously, with the tariff talk, there is a fair bit, the hit to our economy is not that hard direct, but there is talk of that indirect hit through the China economy and the impact there. Can you see that flowing through a bit more going forward, or is it still a little bit of wait and see?
Look, good question. I mean, obviously, people are worried about the US tariffs being imposed on Chinese exports to the US. That will slow, to the extent the price of Chinese exports into the US go up. That's going to dent Chinese growth to a degree. Now, a couple of caveats to that. Firstly, the China have done very well in diversifying away from the US market in recent years. So their share of exports that go to the US is actually not that huge. They actually export to a lot of other countries, Europe, the rest of Asia, more so than the United States these days. Secondly, China, if need be, has a lot of fiscal firepower. It has been and can continue to support economic growth through more fiscal spending, more allowing of infrastructure projects. It's actually announced a number of policies to boost consumer spending. So I think the overall Chinese economy, yes, it'll take a bit of a knock if the trade wars extend, but it can offset a lot of that knock through domestic policy support. So I'm personally not too worried about the blowback onto China, which then might filter through to Australia. At the moment, markets are understandably nervous about that, but I think a bit like, I think the Chinese government isn't going to let the economy fall in a hole here. They'll provide support if need be.
Oh, good to hear. That's certainly a positive outlook on what many are calling going to be our second big issue for the year. But no, that's a really good outlook. I think that pretty well covers everything off from our end, Dave. Thank you for your time today, and thank you for the update for our clients.
No worries. Great to be with you.
Great to see you again. Cheers.